Services accounting at BDO spans all aspects of accounting and financial reporting across 4 pillars: accounting change, structuring advice, financial instruments accounting and reporting, and all other areas. Interest rate benchmark reform features under the accounting change, structuring advice, and financial instruments accounting and reporting, depending on the nature and extent of the support that we will be providing a bank or a building society. Today, I will be talking through 3 areas that relate to interest rate benchmark reform. These are the amendments published by the IASB, the implications of interest rate benchmark reform on cash products, for example, loans receivable and borrowings payable, and the implications of interest rate benchmark reform on other accounting estimates. But first, what is the issue and why are we here? Interest rate benchmarks are reference rates, examples of which are GBP LIBOR, Euribor, and USD LIBOR. They represent the cost of funding in the interbank market for a given currency over a period of time. Since the financial crisis, regulators have looked into shortcomings in terms of how interbank offered rates have been set. This has resulted in the introduction of alternative risk-free rates being proposed and introduced. Examples of these are SONIA, which is the Sterling Overnight Index Average, ESTER, the Euro Short-Term Rate, and SOFIR, the Secured Overnight Funding Rate. It is likely that the contractual cash flows of financial instruments will change upon transition to the alternative risk-free rate. And for accounting purposes, we need to think of this in terms of pre-replacement issues, that is, those issues that arise in the run-up to the reform of an interbank offered rate to an alternative risk-free rate, and replacement issues, that is, those issues that arise in the run-up to the reform of an interbank offered rate to an alternative risk-free rate. And as I said, GBP LIBOR is to be replaced with SONIA on 1st January 2020, which currently exists as an overnight rate and for which the Bank of England is selecting one entity from 4 to administer this rate in its term structure. The latter for SONIA does not exist yet, and its administrator will be developing its term structure methodology. The IASB issued an amendment to address some of the pre-replacement issues that arise as part of the reform in relation to hedge accounting under IAS 39 financial instruments, recognition and measurement, and IFRS 9 financial instruments. As you may be aware, one can still apply hedge accounting under IAS 39, given the IASB has not finished the IFRS 9 dynamic risk management project yet, hence the need for amendments to IAS 39. One can also apply either IAS 39 or IFRS 9 under FRS 102 instead of sections 11 and 12 of that latter standard. These amendments provide relief for some aspects of the reform when it comes to applying IAS 39 and IFRS 9's hedge accounting requirements. This is because IAS 39 and IFRS 9 are specific in terms of what gets accumulated in the cash flow hedge reserved or recognised on balance sheet for the fair value hedge adjustment, and when the cash flow hedge reserve is reclassified from other comprehensive income to profit or loss, or the fair value hedge on the balance sheet is amortised to profit or loss. It is envisaged that interbank offered rates will become more uncertain given interest rate benchmark reform, which will result in the likelihood of the cash flows arising being less likely than highly probable, and the fair value of the derivative and or the hedged item being more volatile. These amendments mean that hedge accounting relationships would not need to be discontinued as a result of the current uncertainty in the interbank offered rate market. There are 8 areas that are amended in terms of hedge accounting under IAS 39 or IFRS 9 that we will now talk through. These are requirements relating to forecast transactions under IAS 39 and IFRS 9, prospective assessment testing that is required under IAS 39 and IFRS 9, retrospective assessment testing that is required under IAS 39, risk component requirements, macro hedge requirements, requirements relating to groups of hedged items, the scope of the amendment in relation to the hedged risk, and additional disclosures that are required for those hedge accounting relationships that are subject to the amendments, given they are impacted by the reform. In terms of the first three items in the list above, one disregards the uncertainty relating to the InterBank Offered Rates when the probability of forecast transactions and performing prospective and retrospective effectiveness testing. To be clear, none of these amendments are applicable to the alternative risk-free rates. IAS 39 and IFRS 9, as they stood prior to the amendments, apply to hedge accounting where, say, SONIA is the hedge risk. On retrospective assessments, as you may be aware, one must perform effectiveness testing on a retrospective basis for a hedge accounting relationship under IAS 39. This relief means that if the entity is applying hedge accounting to an interbank offered rate hedge risk, then the uncertainty of the reform is disregarded when it comes to the 8125 hedge effectiveness test requirement under IAS 39. So, say because of the interbank offered rate uncertainty, the results of retrospective effectiveness testing is 40, and the entity has determined that 50 of this is due to interest rate benchmark reform, then the hedge accounting relationship passes the effectiveness test, given the outcome of the test disregarding the impact of the reform is 90. The uncertainty relating to the reform, that is the 50, is still recognised in profit or loss as ineffectiveness. In relation to the other hedge accounting areas that have been amended, on risk components, one is typically required to assess whether this is separately identifiable on an ongoing basis, but with the amendments, one only does this at initial designation for components that are based on interbank offered rates. In a similar vein, on macro hedges under IAS 39, one is again typically required to assess whether the macro hedges risk component is separately identifiable on an ongoing basis. But with the amendments, one only does this at initial designation for risk components that are based on interbank offered rates. That is to say, it is not a continuous assessment over the life of the macro hedge. On group of hedged items, under IAS 39 and IFRS 9, the amendments are required to be applied to the group of hedged items as a whole. That is, one does not start splitting the group of hedged items and the associated derivatives for parts of the group. Again, it is an assessment at the beginning of the hedge accounting relationship. Finally, the scope's relief has been clarified that the exceptions only apply to cash flow and fair value hedge accounting relationships. In relation to the interest rate risk based on cash flows that are impacted by the reform, on both the hedged item and the hedging instruments. But why does this matter? An entity may be designating both interest rate and foreign currency risk as the hedge risk in cash flow or fair value hedge accounting relationships by using cross-currency interest rate swaps, so they apply the amendments to the former but not the latter. The typical requirements apply to the hedge accounting of the foreign exchange risk. A couple of questions may have arisen in your minds. Firstly, are these amendments mandatory, and if so, to when? They are mandatory for all relationships to which hedge accounting is being applied as at today if the amendments are early adopted, and are mandatory until the uncertainty arising from the reform ceases, which is subjective and involves consideration of interbank offered rates separately in terms of their impact based on the relevant facts and circumstances, or the hedge accounting relationship is discontinued, which is objective as either the hedging instrument is extinguished, the cash flow hedge is reclassified in its entirety to profit or loss, the fair value hedge adjustment is amortized to profit or loss, and so on and so forth. The amendments can only be applied when they are endorsed by the European Union, and as of today, the European Union is still expecting to endorse this before its effective date of 1st January 2020. However, one cannot early adopt if the European Union does not endorse the amendments. There does appear, however, to be a degree of leniency for these to be early adopted if endorsement were to slip into January 2020, given the interbank offered rate markets are not that volatile in the short term. The Financial Reporting Council have issued an exposure draft similar to the IASB and has said that they would reconsider this based on what the IASB issues. This is on hold in light of the upcoming general election, but the hope is that the FRC will issue similar amendments shortly after the 12th of December. So we've spoken a fair bit about hedge accounting. Let us turn to the implications of interest rate benchmark reform on cash products. For example, loans receivable and borrowings payable. Lenders and borrowers may need to modify contracts. This may be the case if fallback provisions contained within the contracts only address instances where interbank offered rates are not available on a temporary basis, and it is a requirement to start to include such provisions under the benchmark regulation. A term structure exists for interbank offered rates on a forward-looking business basis. That is to say that one can obtain today a rate for LIBOR that would apply to 1 month, 3 month, 6 month and 12 months, with liquidity premiums being incorporated as one moves up the curve. Alternative risk-free rates are currently set on a backward-looking basis, based on the market activity the day before. They are therefore not available until the end of the interest reset period, and the borrower therefore does not know what they will be paying until after the event. Other factors to consider in terms of financial instrument accounting are credit risk. Interbank offered rates inherently include credit risk, as they are set between banks based on what they will lend to each other at. Alternative risk-free rates will probably be set based on very short-term unsecured trades, so are expected to be lower than the equivalent interbank offered rate. Finally, alternative risk-free rate markets are currently illiquid and volatile. For example, SOFR was fluctuating between 1.5% and 9% over a couple of days in September. In light of all these variables, lenders and borrowers may decide to renegotiate or fix the term of their financial instruments. So, what does this mean, therefore, in terms of recognition and derecognition of financial instruments? There are 3 schools of thoughts in this respect. Nothing happens when one changes from an interbank offered rate to an alternative risk-free rate. Secondly, one could re-estimate the cash flows as a result of the change from an interbank offered rate to an alternative risk-free rate, but not the rate itself that is used to discount them. The third possibility is assessing whether one needs to derecognize the current financial instrument and re-recognize a new one. Under IFRS 9, there are also implications as to whether a financial instrument using an alternative risk-free rate meet the contractual cash flow test, which is also known as solely payments of principal and interest, or SPPI. As we said on the earlier slide, lenders and borrowers may prefer to move from floating alternative risk-free rates to fixed rates, given the impact of discounting over the long term. This may give rise to derecognition and re-recognition for contractual modifications, if they are substantial in quantitative terms or qualitative terms, given the pervasive nature of the change. If there is no derecognition, then there is another question as to whether one updates the interest rate and associated cash flows with no adjustment arising as a result of both sides of the equation are increased by the same amount, or update the cash flows but not the interest rate. That is to say that one discounts using the interbank offered rates, with the difference arising between recognised in profit and loss or as a one-off adjustment. The preference in any situation is to just update the rate and the associated cash flows, but this would require an amendment to IFRS 9. This is something that the IASB is currently discussing. On the second aspect, interest under IFRS 9 is to, in the main, represent compensation for time value of money and credit risk. IFRS 9 has a modified time value of money test, whereby when interest resets to a duration that is different to that of the reset period, say 12-monthly to 12-month LIBOR, In such instances, one needs to determine how significant the difference is, and if it is, then this would not pass the contractual cash flow test. Also, given the current difference in the basis on which alternative risk-free rates and interbank offered rates are set, one may form the view that the instrument does not compensate for the time value of money in qualitative terms. This is another area that the IASB is currently discussing, but without relief, more instruments may be measured at fair value through profit or loss. Interest rate benchmark reform may also impact other accounting estimates. This is mainly when an interbank offered rate is used as a component of a discount rate. The change in an interbank offered rate to an alternative risk-free rate could therefore also give rise to a one-time impact as at the date of the change, or on an ongoing basis, given the discount rate will inevitably be a bit lower for reasons outlined previously. Examples of where this might have an impact are as follows: pension liabilities, estimation of the value in use for the purposes of performing impairment testing under IAS 36, discounting of provisions under IAS 37. While unlikely, it could also be used as a factor in fair valuing investment property under IAS 40. It could also be used as a factor in determining the effects of an IFRS 2 equity-settled share-based compensation scheme. More importantly, interbank offered rates are used in discounting some financial instruments so as to estimate their fair value under IFRS 13, including non-current intercompany loans that are interest-free. Interbank offered rates may be used to discount significant financing components under IFRS 15, an example of which is deferred payment terms. The same applies to IFRS 16 when the interest rate or lease payments are linked to interbank offered rates. And finally, interbank offered rates may be used to discount insurance contract liabilities. And whilst we have outlined the IFRS standard, the considerations would also apply under UK GAAP. So, a lot to take in. And as one can see, interest rate benchmark reform impacts accounting, but not only. There are some other areas on your screen at the moment. So what should you be thinking about and doing? Start a project in this respect from people from across the business, given the wide-ranging impact of interest rate benchmark reform as we saw on the previous slide. Determine the extent of your interbank offered rate linked exposures for assets and liabilities. For those financial assets that you have originated, assess the impact of those contracts that do not have proper fallback clauses. Come up with a plan for debt issuances and other interbank offered rate borrowings. Review hedge accounting strategies. On a go-forward basis, include proper fallback clauses in contracts. Establish fallback scenarios where they are not contractually stipulated. And engage internally with your customers and funders and your shareholders.
Mark, maybe a question, which I think is common for a lot of people on the call. If I've got a generic hedge relationship using LIBOR swaps and my year end is 31 December 2019, is there any action I need to take for the 2019 year end from an accounting perspective, or do I continue just to apply the normal hedge accounting rules for this year end?
I would advise clients to apply the normal hedge accounting rules, given the fact that there is relief whereby the hedge risk is LIBOR linked. If you were to change it to SONIA, then there is no relief for that. And if, for example, you're applying IAS 39 and you fall outside the 8125 prospective or retrospective test, then you would need to discontinue hedge accounting.
Thanks, Mark.
And finally, your auditor will be interested in a number of things, including understanding the extent of your interbank offered rate linked exposures. How is the impact of rate and methodology changes being assessed and implemented? How are you interpreting and applying accounting requirements? The governance, process and controls that are being designed and implemented in light of interest rate benchmark reform. How is all of this being disclosed in the financial statements? And, with the best will in the world, given the complexity, mistakes may be made, giving rise to conduct claims. So in short, how is management responding to interest rate benchmark reform? And now we will take a few questions if there are any more.
Yeah, I think at this stage we will gather the questions. Please keep sending them through, and we'll pick up any additional questions at the end.
Well, thank you very much, Mark. Hi, it's Oyvind Andersen here. So I'm going to cover the second part of this session. So I'm going to talk about some of the regulatory challenges firms are seeing, particularly with a focus on the PRA and the kind of the prudential aspects. So what kind of things firms are seeing in the sector as a whole, and I guess also what we see actually coming from the regulator. And so you see on the slide on the screen here that I've sort of highlighted 9 key issues here, and this is things that we have, sort of anecdotally, seen from talking to loads of banks. There's also been some of the kind of the more risk service out in the market has flagged, and some of them are probably quite familiar with you. And the top 3 ones I've sort of bulked into operational resilience, because obviously we see, technology risks emerging as firms are becoming much more complex. We see, firms are increasingly relying on third parties for things like outsourcing, giving, more technology, more specialism, more specialist products. And then we also see, as a result, increased operational risk given at this environment. So in order to effectively mitigate that, that's where, the regulators have been heavily focusing on operational resilience. So we'll cover that in a second. There's also some other key risks that are emerging. Some of them I'm going to cover, some I am not. I'm going to spend some time later, as we'll see, on regulatory reporting. There's been quite some exciting things happening there over the last week or so. As if you've read a newspaper, you've probably seen there've been some headlines. I'm not going to talk about Brexit, so you'll be pleased to hear that. I'm sure you hear that pretty much every day. Financial crime I'm not going to cover, but it's obviously a very important topic. But I will touch on governance and culture, because that's something we see with pretty much every risk that a bank is or a building society is exposed to. The regulator will focus on the governance and culture aspect. So that's already the overview of the risks, and the way those kind of challenges are transforming into sort of firms, on firms' agenda. I've highlighted sort of 3 or 4, key aspects. So the first is sort of your threat feedback. So this is where you had the review with the regulator. We've seen firms have been increasingly challenged on things like their Pillar 2B requirements. So I'm going to talk separately around that. Operational resilience, I mentioned. We're going to look at that and the kind of the operational risk as well, which I guess drives that. Then on the regulatory reporting side, I'm sure most of you have seen the Dear CEO letter from the chief executive of the PRA, where they talk about kind of firms' requirement to improve regulatory reporting. There's been some stories in the last sort of 6 to 9 months, with Metrobank and also very recently with Citibank. So we're going to look at some of those issues, because I think quite a few of those issues there are drivers for these, their CEO letter. And some of the things that we're going to pick on in particular is around the kind of the gaps we've seen in technical knowledge. Some of it is driven by, more complex products. And we also, the issues with, governance and oversight as well, again, linked to the culture point. There's also a couple of new things that are being implemented or have very recently been implemented around the PRA 1110. This is the new liquidity return that has replaced FSA 4749. We're going to share with you some of the PRA feedback we've seen there, and also some of the challenges that firms have seen. And then finally, I'm going to talk a bit about sort of the CRR2, sort of new sort of a round of BASEL rules and how they are being implemented. Going to touch on particular firms with counterparty credit risk and market risk challenges, and also the wider Basel IV longer term requirements. So those are the kind of things we are specifically going to talk about. So if we go into the next slide and look at this.
And just to pause for a second, just to remind people who dialed in, we will circulate the slides and a recording of this, so you don't need to take copious notes as you go along. Just a reminder.
Well, thank you very much, Ariel. Yes, I will continue to talk now about the threat feedback. So we've seen several firms over the last, 6 months have been giving higher Pillar 2B add-ons than we sort of seen historically as a percentage. And we think a lot of the kind of drivers behind those add-ons comes from regulators paying more focus to firms stress test, and this is particularly on for fast-growing firms. And again, there's been a Dear CEO letter to fast-growing firms, challenging firms around the kind of relationship between your loss rates and your balance sheet growth, for example, and also given I think that we can see that we're getting towards the end of the economic cycle. What would your stress tests looks like? So a lot of more challenge there, particularly on the SME lending side. I think that if you are involved in things like ICAPs and you are looking at your stress testing, bear that in mind, that there's a lot of additional challenge from the regulators. As I said, there's a particular focus on SME lending, so less sort of on the retail and the mortgage side, more on the SME, and also to some extent on the corporates. The PRA has also taken quite a keen interest, we've seen with some firms, doing deep dives on things like credit risk, both through an internal audit perspective. So they've asked, the internal audit to have a look at credit risk. We've also seen there being some themes around where they've gone around to firms asking for specific information, etc. So I think I know there's been a lot of focus on other risks like regulatory reporting or operational risk, but I think obviously banks and building societies, lending money to external counterparties, credit risk is always a key risk. So yeah, please don't lose focus on credit risk. It comes back again and again. And as part of that kind of threat feedback, what we've also seen is that the kind of the increased use of the risk sort of management and governance scalar. This is for the Pillar 2 as well, where perhaps there have been some PRA has had some challenges with the way firms manage risk or governance, or there's been some particular issues. The PRA has used the tool that they have, the scalar, which they tell firms to please fix X, Y, Z, and then we'll remove the scalar. So again, that tool has increasingly been used and for several firms. This comes back again and again. So I think if you want to avoid that, just be aware of being upfront with the PRA, sharing issues with them, etc., as opposed to them detecting those issues and giving you a scale. I think that's probably my sort of key takeaway on that particular point on the threat feedback. If you move on to another thing that you may recall I talked about on in terms of sort of key challenges, the operational risk and I guess the operational resilience attached to that is always on the forefront. So I think it's been defined in many ways, but I think they're kind of the four sort of key things that if I were to combine those issues to talk about is that kind of the operational risk is the kind of that operational disruption can cause, ranging from having poor legacy systems or having issues with with IT and in general, to more sort of traditional failures like human errors, for example, like fact fingers or someone not following your process, for example. Just to give some examples, these are always on at the regulators' forefront. And operational resilience is then sort of defined as the outcome of a bank's practices and processes and culture working to effectively mitigate these operational risks. And therefore, you will limit the impact if these risks were to crystallize. Because I think the key thing here is that these risks are always there, but it's how do you actually mitigate those risks? So, for example, if your IT system is down, what kind of mitigants will you have to, do you have an alternative system? Do you have manual workarounds, etc.? Incredibly important on once you have identified the risks, actually to have some good mitigants against them. I think a key one that's really been flagged by the PRA that we've seen and they've surveyed several firms, etc., is the sort of the cyber threat. And I think what they're worried about there is really that given the sort of the focus on technology, and firms are more and more operating within the cyberspace and linking with customers, etc., online, is that there's a cyber threat to, the UK financial system. Things like hacking, distributed denial of service attacks, and so on, frauds, etc. Through technology. So the regulators are very, very keen on firms having the appropriate, mitigants and sort of workarounds, to combat cyber threats. So that's really where a lot of the focus on sort of operational risk, but also on operational resilience has been. And you see that from sort of the third box, IT resilience and cyber security, absolutely key. I think one other point to add as well is around outsourcing. If you outsource services, that's great because you can make savings, you can outsource things to experts, but at the same time you cannot outsource the risk. So if you outsource any form of technology or service, etc., regulators are very, very keen from an operational risk and resilience perspective that actually you control that outsourcing process. So if things were to go wrong, you can demonstrate that you are resilient. Really, really important on operational resilience. What I have on the next slide is some of those mitigants, I think, for firms to consider. So if you're sort of taking a step back and actually looking, how do we manage operational risk? How do we manage operational resilience? What are the key challenges? So I'm not going to read through all of the 10 boxes we have there, but I think it's really important to, for firms to appreciate, actually what kind of governance do we have around operational resilience? Is this on our internal audit sort of timetable? Do we actually look at operational resilience holistically, or is it just something that a couple of guys in IT look at, or a couple of guys in the sort of front office look at? What's actually the key? How do we govern operational resilience? And sort of linked to that is actually who's responsible for this. Who sponsors the kind of the project around operational resilience? Is it someone further down, or who at the board and sort of senior executive levels really sort of kick the tires on this? Really, really important to identify and link to things like your SMCR regime, etc. Really key.
Just picking up on one of the questions coming through. Clearly, operational resilience is a big deal at the moment. Who do you see is owning it at a management level? Because it's so broad and far-reaching, who's actually owning this and trying to make change in that space?
That's a really good point, actually, because I think it depends on the firm's business model, but there should definitely be someone, I think, fairly high at the top. So the board will have, obviously, from a sort of a third-line perspective, have ownership over it. But I think on the executive level, it should be go someone equivalent to the CEO or very close to the CEO. So like a direct delegate, like a CFO, for example. Depends really on your business model, but it needs to be right at the forefront of the firm's agenda. It's incredibly important, but I don't think that the regulators have a particular view on who it should be, but it should be right pretty much at the sort of the CEO level. I think that's but I've seen various models depending on the firm's business model and the sort of strengths of various functions.
And then just a follow-on question we've gone through. People are talking a lot about operational resilience and have in the past. Are you seeing a step change in terms of how organisations are trying to tackle this, or is this more a bit of a documentation type exercise?
No, I see definitely a step change. I think some firms have, there have been some horror stories out there in terms of things that have gone wrong. I think we had this sort of TSB issue, for example, last year. And I think firms, as a result, have invested in this, and there's been a lot of training, for example, at board and senior executive level. So there's been operational resilience now on things like skills matrices, for example. Some of the kind of the IT staff has been elevated, percent to the board. A lot of good investment, I think, there. Some of it's been forced by the regulator, but I think some of it has definitely been there. We also see that kind of internal audit has played a big part as well. It's been on the firm's sort of internal audit agenda. And as a result, those findings, some of the big red findings have come out, and firms have taken action. So really, most firms, I would say, have taken a strategic view and looking at things like IT strategy, looking at things like cyber strategy, looking at things like outsourcing strategy, not just doing this as sort of small pieces of work. I think where I still see there are some issues in terms of operational resilience is around change management. I think there's still a lot of things to be done there in firms, and I think change management is actually quite a big operational risk. I think TSB was a good example of that, where they implemented the Spanish owners banking platform into the UK, and although people thought it went well, it didn't go well. And I think it's just really important to make sure that things like, not just kind of the sort of the sexy stuff like IT and cyber and sort of the kind of hacking, but it's actually things like basic operational risk management, like change management. I think that's where firms have some time to go.
Thank you.
Yep. And just moving on to the next slide, as we sort of covered operational resilience, I just want to touch on regulatory reporting as well, because that's been in the headlines as well recently. Last year there was some news on Metrobank, and there was a regulatory reporting error, and it went to the papers. It was quite reputationally it was quite damaging, and there's also been recently Citibank, which I'm going to touch on as well. And the PRAs, they have sent out a Dear CEO letter to all banks and building society, expressed concern around the quality of regulatory reporting. And, so there's been loads of, errors, resubmission, lack of governance. They're seeing various sort of firms not implementing, sort of recommended changes, etc. And all of this now is a fairly mature process. If you look at things like co-rep, for example, it has been around now since Basel III was implemented, the CRD4 in 2014, January 2014. So firms should be maturing to this. What we have seen, and I think what is key for firms to mitigate this risk, is really to make sure that you have the right governance. That's one of the boxes you see in the slide here. So have you documented your regulatory reporting at sufficiently granular level, and not just kind of the guys producing it, but actually the kind of people that are reviewing and challenging it well. How does that governance model work? In your target operating model, and also what kind of internal controls do you have? And our experience with some firms is that they documented this 3-4 years ago, and then perhaps after they had an internal audit, and then sort of left it. This needs to be a sort of a live environment where you constantly review and update and challenge these controls, and do that on a regular basis. That's, I think, another thing the regulators are looking for. It needs to be live. Where firms have been challenged as well by the regulators around the kind of regulatory rule interpretation. So there's things like, if you're, for example, with, in the property finance, for example, mortgages and so on and so forth, standardised approach, kind of how do you find, what should be risk, whether 35%, 50%, 100%, or 150%. Again, some of the Metrobank issues were around the rule interpretations. We've seen the same with Citibank as well. So I think, again, the more you can document and challenge that, and rules, and have that written and sort of shared with key stakeholders within your bank or building society, and if possible, take it quite high up to the board if it's critical for your business model. I think that's where those rules should sit, not by someone, like a reporting accountant sort of on the side, if this is critical for your business model. Because if you get it wrong, it has an impact on pricing as well. So really, really important. And I think also on the IT and data side, what we're seeing, the kind of regulatory reporting is sort of like an end-user system feeding off other systems, perhaps not fit for purpose, or things have changed, have been underinvested, and as a result, there's a heavily manual process. And again, that has costs firms, issues. Again, looking at this strategically and see, is it worth investing from an IT perspective is important. Really, really, I think it's key just to be aware of those issues, given the severity of getting regulatory reporting wrong. Just moving on to the next slide. What I have here is just some example of sort of googling sort of Metrobank and Citi. You see straight away. This is basically driven by regulatory reporting these issues. So Metrobank, they classified parts of their loan book incorrectly when it comes to risk-weighted assets. Citibank had issues with both their sort of liquidity coverage ratio calculation, the LCR, and they also had issues with the way they reported their capital ratio, basically risk-weighted assets again. So Citi were fined 44 million And the PRA has actually helpfully written a huge sort of note where they set out what all those issues were. And I'll just summarize some of them. But again, you see here there's things like systems and controls not being in place and operating effectively, lack of allocating human resources. There's documentation is poor, technical interpretation is not right. Again, we talked about that, it hasn't been elevated to the right decision makers, and the overall sort of board and sort of second line oversight not there. And as a result, they were fined spectacularly, and also have a huge remediation program as well, which is, I'm sure will cost probably the same amount. So again, incredibly important to get your regulatory reporting right. If we just move on to something closely related to that, so recently the PRA has implemented the PRA 1110 return. This is sort of quite specific, but I think it's really important because it's effectively their main liquidity return. So it replaces the FSA 47/48 return. And we have seen a lot of firms once been challenged by the regulators from some of the assumptions they're using there, and they've also been challenged in things like internal audit, etc., not getting this right. And I think one of the reasons for that is that this return, and I have some bullet points here around, it's more complex than FSA 47/48, more required input, additional granularity, and looking at more details of things like derivative positions, including contingent flows in times of market stress. So, and it's also linked to your sort of LCR weights and blended weights. So yes, great, it can be reconciled back to the LCR and some of the other liquidity returns, but that's actually some of the challenges we've seen from the regulators, that they have asked firms to reconcile this new return back to your balance sheet, to ALMM return, to the old FSA 47/48 and the LCR. And I'll just highlight some points there around, there's 260 rows, 112 columns, so there's 29,000 potential data points. I think you have to be pretty sophisticated to get all this 100% correct, and also to build a proper system around that is a big challenge. We see most firms, at least the sort of smaller banks and building societies I work with, do this on a manual basis, so extracting it out of other systems. And again, that can work tactically, but it takes a long time, and it may increase things like operational risk. If you get one calculation wrong or a cell wrong, that may have a significant impact. So I think again, it's important for firms to be aware of some of these challenges, invest the right amount in time, and make sure that you can reconcile them back to the key regulatory systems.
Quick question coming in.
Yeah.
What type of assurance are organisations trying to get on their PRA 110? Is it typically internal audits, sort of different line of defence, validation, external? What type of assurance are finance teams getting over this return?
It's a good question. So what we have seen, several firms have added this to their internal audit business plan. And as they're undertaking this as part of any other regulatory review. So, for example, they look at liquidity regulatory reporting, and so the internal audit has sponsored that because it's flagged as a big risk. People look at this return and say, oh, it's 29,000 data point, high risk. Some other firms have gone out as well to ask for more consulting from third parties. So we've helped some firms, with second line reviews. We help with some of the interpretations of where firms have sort of documented, cell X should go to cell Y, what's the rationale for that? So there's sort of, I guess there's many ways to skin a cat, if you like. But I think it's getting that external assurance where you're not sure it's worth investing in that, given if you get it wrong, then the implications down the line may be severe. My experience with the PRA is that when there's a new return, they give you a bit of period of grace where they're sort of quite happy for firms to improve and resubmit and change. Typically that lasts about a year, and then sort of they push firms harder. So I think the more you can invest in that initial time and have a dialogue with your regulator, speak to other banks, go to sort of to fora, etc., and discuss that. The more the better, to be honest.
No, that's really helpful.
Yeah.
Thank you.
So that's kind of the sort of headlines on the 1110. What I just wanted to spend the sort of last 5 minutes or so on is talk a bit about what we call Basel IV and CRR2. So as we all know, there's more regulatory, changes coming down the line. So the first one is the CRR2, which is sort of in 2021. So this is basically an update of the regulatory, reporting regime, and then we have the more sort of fundamental Basel IV, coming in 2022 plus. That hasn't gone through the European Union yet, and therefore not into sort of UK legislation. But we expect that will happen sometimes after 2022, and I'm quite certain that most of these changes will happen irrespective of Brexit, given the PRA's and the Bank of England's input into this, and also the fact that a lot of these rules come from from the Basel, which is kind of the global sort of central bank, if you like, that sets these rules. So I think it's a key takeaway in terms of the timelines is that the kind of CRR2 will take place in 2021. And the key changes there for most firms is if you have counterparty credit risk exposures, there'll be changes there to the calculations. We're going to look at that. There's the market risk changes, mainly on reporting. And then there's the finalisation of the Basel II and sort of CRD4 liquidity and leverage ratio rules. The other changes around sort of capital floors and operational risk and the new credit risk rules will come in with Basel IV, sort of 2022 plus. So what I have here on the next slide is quite a lot of detail, but I think it's useful just to give people some good sort of oversight of what these changes are. So we see capital floors, for example. They will come in as part of Basel IV, so 2022 plus, which is basically will help firms that are on the standardised approach. So there'll be a floor that the kind of internal rating-based firms can use, which eventually will come to 72.5% of the standardised. So, if the standardised risk weight is 100%, then, the IRB floor, if you like, is going to be 72.5%. So this will impact banks on the IRB method, but will good for some of the, the smaller banks in the sense that it will, level the playing field. Other change we see is around counterparty credit risk. And there's updated standardised risk weights for real estate and project finance. I have a separate slide on that, but the headlines there is that the better the loan to value, if you like, on your products, the lower the risk weight for standardised. Counterparty credit risk, they are changing the current exposure method to a more complex and sort of risk-driven measure called SA-CCR. And then also we have changes to operational risk for Basel IV, so this is where they're going to get rid of the AMA approach, and they will also get rid of the BIA approach, and they'll create a combined approach called where you'll look at both the business indicator and also loss rates for larger firms. So again, some key changes. On liquidity and other risks, what we see there is the NSFR, so net stable funding ratio, is finalised, leverage ratio is finalised. They're talking about introduction of new risks like step-in risks. They're linked to the Recovery and Resolution Directive, where the total loss absorbing capacity and MREL requirements are being implemented, along with a securitization refresh and IRBB being formalised. On market risk as well, we see some changes. So the FRTB, which some of you have heard about, the fundamental review of the trading book, that is being introduced. That's currently back at the Basel sort of drawing board, so we don't think that will be implemented anytime soon, given the complexity, but there will be some reporting requirements. So that's kind of the key changes. On my next slides here, I have a lot of detail around the kind of the key changes to the calculations. I'm not going to go through that, in this session because it's quite detailed, but I think it's really useful for you dialing in and, looking at this presentation to, to have this in the background. On the counterparty credit risk changes, all I will say is that there will be additional calculations to the potential future add-on calculations. So it's not just the kind of the factor based on product as we used to have. They actually introduced some more supervisory metrics like duration, delta, maturity factor, and supervisory factor, whereas in the past it was much less sort of onerous. So that adds some complications to the way you calculate potential future add-ons for firms. If you have a big sort of counterparty credit risk book, then that may potentially have an impact. I talked earlier about sort of the credit risk changes on SME exposures. We see, and again, there's a lot of detail here, but we do see there's some supporting factors being introduced. On infrastructure finance, there's also a supporting factor. Capital floors I talked about, and we have, risk weighting for exposures will change. We'll see that on the next slide. This is where, as I said earlier, if you have a sort of property financing, residential mortgages, etc., depending on your LTV band, you will get a different risk weighting. So it's not the kind of 35% or 100% anymore. Much more granular. So again, if you have low LTVs, you will benefit. I think that's the key thing for sort of standardised banks. For IRB banks, it will be more. It will probably be a drawback. So that's the key changes there. And just finally, on operational risk, again, a very busy slide, but we have not just the kind of income-based measure for Pillar 1 as we have at the moment. We are required to include loss data as well. And I think that will have an impact for quite a few firms. Again, that's a Basel IV requirement, so further down the line. And then finally, I just have a sort of a couple of other risks there. Step-in risk will impact some firms if you have very close relationship with some of your suppliers. If they go bust, for example, you will have to effectively consolidate them. Interest rate risk in the banking book that's been formalised, has to be elevated to board level with the right board risk appetite. Really, really important. Securitisations, I think it's probably less relevant for some of the firms here today, but there's new proposals here. Simple, transparent, and comparable is the theme, so making it more straightforward. And then finally, formalisation of the MREL requirements, for firms. And I think the ones of you who are subject to MREL should have already been told the requirements by the regulators. So that's all I wanted to talk to today about in terms of challenge. I think we have 5 minutes or so for questions, so I'll just hand over to the floor.
Yeah, so just some of the questions coming through. Maybe a question for you first, Ivan, and then one for you, Mark. The first one is on there seems to be an option to report the NSFR on a simplified basis. If you could maybe just clarify, who does that apply to, and does one need regulatory approval for that?
So there's I think there's no regulatory approval as such, but there's certain thresholds that you need to meet, and I think it's just things like balance sheet size, etc., whether you can use a simplified approach for the NSFR. So I think what you need to do there is really go back and look in the rule book and identify, are we below these thresholds? And I think as a second step, tell your regulator, your supervisor, that basically on sort of principle 11 basis that yes, we have identified that we're below this threshold and we're going to report it on that basis. I think that's the kind of 2 steps up it, take from that perspective.
That's really clear. And then a question from Mark. Question around organisations trying to take out SONIA swaps and then trying to enter them into hedge relationships. Are there currently reliefs available around hedge effectiveness for taking out SONIA swaps, or are the envisaged reliefs available?
At the moment, the IASB has only issued relief for LIBOR and any form of IBOR-based product, and the FRC has done the same. As part of phase 2 of the project, the IASB has taken on board to look at wider issues, including changes to cash-based products and other areas of accounting, and this includes consideration of replacement-type issues that would arise as the reform progresses over time. So it's a case of one to watch for the future. I would expect there to be some form of relief when the methodologies crystallise on the term structure basis and things become clearer, but at this point in time, there is no relief for SONIA, and hence why the response earlier was to continue LIBOR as much as possible for the foreseeable future, because you do have relief in that space.
Thank you, Mark. I think I'll pause it there, maybe give a minute or two back to everyone who joined us today. Just before we conclude, a big thank you to Mark and Oyvind I think these were really important topical issues, and thank you for sharing your insights with everyone.